Welcome to Short View Trading. It's Monday 27th of March around 9:30 a.m. London time. And what are the factors you want to watch if you're trading equity index futures on a 1 to 2 week basis? If you're a swing trader of S&P futures or other equivalent equity index futures, that's what we want to get into in this video. What drives markets on that 1 to 2 week time frame? Well, it's been a pretty strange month so far if you think about it. We've had a major crisis in the US banking system, a couple of major banks going bust, a deposit run in the regional banking sector. And yet despite all that, the S&P 500 is pretty much flat month to date over the course of a month up to the close last Friday, 24th of March. So how does that work? What's going on there? And why is it, if you look at this chart in front of you now, about month to date performance across major global equity indices, that the US, as I said, is broadly flat, the Nasdaq's up, and in fact, European equities are the key underperformer. Now, of course, part of that banking crisis spilt over into Europe. We saw what happened with Credit Suisse. The key to understanding this differentiated market behavior over the course of March is digging into the sector performance in the US. And in fact, if you look at the chart in front of you now, where we split the S&P 500 into three very big picture sectors, the cyclicals in aggregate, industrials, financials, and so on, energy in there, the defensive sectors, things like staples, healthcare and so on, and then the long duration growth sectors, the tech, the Amazons, the communication services, these kind of areas of the market. If you split the S&P 500 in that way, you start to get a better understanding of what's really going on. And indeed, as you can see in the chart, the defenses are broadly flat, tech is up a lot, and the cyclicals are down meaningfully over the course of March. And then if you roll that out across the globe, you look at European equity markets, they're very heavy in terms of cyclicals. They're much more of a cyclically based index and much less tech, almost no tech really in Europe, a few percentage points weighting in the major indices. So tech and growth are much more a US story, cyclicals are much more of a European story. And what the banking crisis is telling us in the States is the recession in the West, and indeed globally, is much more likely and now is being priced into global equity markets. So tech is up though. Why is that? And of course that is a liquidity story. So with the Fed reacting to the banking crisis by setting up its bank term funding program, pushing a lot of liquidity into the market. That's got to go somewhere, hasn't gone into the regional banks. As you can see from the regional banks chart in front of you now, they're deeply beaten up. The price action looks terrible. But the liquidity's gone into tech, which has performed nicely over the course of this month, and by the way, is now actually overbought. So once you break it down into a sector pattern, once you look at the underlying drivers, you can start to make sense of what's going on. Liquidity going somewhere into tech, cyclicals increasingly pricing in recessions, consistent with what we saw in US 2-year bond yields, and defensives up a little bit on the month, and the real center of the weakness, the regional banks, and indeed the office REITs, which are becoming increasingly the center of this economic weakness, both those areas of the market down sharply over the course of March. So the question is, what do you do with this market now? Now that it's moved as it's moved over the course of March, what's the outlook over the next 1 to 2 weeks? And that's what we dig into each and every day in our daily RAG product. Our RAG Trader publication comes out around 8:30 London time every morning, every trading day, with an update on our models, our 1 to 2 week greed and fear models, which give us good insights into the likely 1 to 2 week swings in equity index futures, plus an additional commentary on how we see the market and a broader understanding of how the market's been trading and how it's likely to trade on a 1 to 2 week basis. So if you're interested in a trial of that, please click on the link below, enter your name and email address, no credit card details required, and we'll send you the daily rag for free for a bunch of weeks. Or if you're a subscriber, should be in your inbox by now. So what are we watching today and this week? Well, there's a lot of stuff going on, but particularly we're focused on price action, the price action of indicators of stress, whether that's TED spreads, CDS prices, or the price of bank shares, amongst other factors, like European and US high yield corporate bond spreads. All of these we're watching closely. Is the market showing more signs of stress or less? That'll be critical for the way equities play out from here. But apart from that, there's bits and pieces of macro data over the course of this week. In Europe, for example, there's a flash inflation data point at the back end of this week. In China, we got some manufacturing and non-manufacturing PMIs also at the back end of this week. And then over in the States, there's bits and pieces throughout the week, including consumer confidence earlier this week, and then pending new home sales, And then we've got Chicago PMI and personal income spending on Friday. So lots to focus on. Central bankers speaking as well across the spectrum from the ECB, the Bank of England and the Fed. Keep an eye out for those things they have to say. Any comments on the banking system as well, of course, watch closely as well. So that's it from us. That's your morning market hit for Monday, 27th of March. Thank you for listening. Please do subscribe to these videos on YouTube. Simply click on the subscribe button or follow us on LinkedIn, Twitter, and on Facebook. Thank you for listening. Trade well.